so. At the end of this panel, we will actually have time for live Q&A, so do feel free to send those through in the chat on the app to interpret the results of the poll, which are astoundingly in favor of federal policy uncertainty, including the expiration of tax credits at 74%. Over to you, Ethan.
Thank you, Dana, and hi, everybody. So yeah, the subject of this panel is the challenges around financing, which, according to this poll, though, we've already solved, and we can probably just take off and we're done here, which is really intriguing that people were very comfortable about feeling about the availability of capital. So I'm very lucky today to be joined by a terrific panel of folks with real deep expertise in this area. And also, they bring a diversity of perspectives in terms of the roles that they play in the financing and the development of projects here in the United States. You have their bios, so I'm not going to go through them one by one, but I'm going to maybe start just to kind of almost work my way from down the stage here, because I think we actually have kind of a natural progression here, starting with the developer, an equity investor, down at the end, a financial institution, a major bank, and then, of course, an insurer. So let's start, though, with you, Matt, to talk about, from the developer perspective, kind of, if you could, tell us where we are now in terms of trying to get the volumes of projects financed that we saw Trina talk about. So by my count, you know, we at BNEF say that about 350 gigawatts of new capacity is going to get built over the next 5 years. Ballpark, that's, let's say, $350 to $400 billion of capital required. Where are you guys now, and how are things going in terms of the availability of capital?
Sure. So certainly from a developer perspective, the scale of today is sort of unprecedented in terms of the type of demand that we're trying to satisfy. So Invenergy is the largest privately held developer of clean energy infrastructure projects in North America. And since inception 25 years ago, we've commercialized more than 36 gigawatts of projects. And that's really across gas, solar, wind, storage, across technologies. And the pipeline in which we're trying to execute on in the next 4 to 5 years is about, 35 plus gigawatts. So if you take that into perspective, it took us 25 years to get to 36, and we're trying to execute on that same amount of capacity over the next 4 and 5 years. So just the amount of scale is unprecedented that we're seeing opportunities to fulfill.
Maybe if I could, though, just in terms of the availability of capital right now, sort of what are you seeing at the moment?
I mean, there's plenty of availability for capital. It seems like the project finance debt market is very liquid. We are competing against other large infrastructure projects, as well as other developers that are trying to accelerate the execution of their pipelines over the next 4 years to qualify their projects for tax credits. So, I think that's going to be potentially more of a human resource constraint than a capital constraint in the near term, because the banks that are financing our projects are also financing the data centers, the LNG terminals, et cetera. So I think, human capital constraints is definitely a concern, but it doesn't seem like liquidity is a concern, at least in the construction debt market.
Susan, I want to bring you into the conversation with HASI, and maybe first, if you could tell us a little bit about HASI, but then also, your role as an equity provider in this market and where you see things.
Sure. Thanks, Ethan. I'm the Chief Client Officer at HASI, and we're a publicly traded financial investor in infrastructure, sustainable infrastructure assets. And we invest across the whole spectrum of utility scale with partners like Invenergy, but also distributed generation, resi, C&I, community solar, and fuels, transport, and nature. So we're tracking, and we have over $16 billion in assets under management. And last year, we invested over $4 billion in new assets projects, across those different sectors. So I would say, we've had a lot of uncertainty, particularly we talked about policy and whatever. So sometimes during those times, we naturally see more of a flight to quality. But at the same time, we still see a lot of capital, particularly at the asset level, involved in looking for good sponsors, good assets, good infrastructure. So we partner alongside tax equity, we'll talk more about that today, and sponsors and infra funds who are also bringing capital to invest at the platform level. So I think with, again, good projects, good sponsors, and more policy certainty will help. we'll be able to bring the capital we need for the demand side, matching the demand side.
Thanks for that. And I want to come back. You raised a couple interesting things about the tax equity market. And then, of course, our poll suggests a lot of uneasiness about policy uncertainty. And we should talk about how that interplays with finance and the kind of terms that are being demanded. But I want to bring you, Dean, I want to bring you into the conversation, obviously from a large multinational bank perspective. How do you look at the U.S. for opportunities? And what are some of the things that you're looking to back in this space?
Sure. I think by way of background, BBVA is involved across the financing spectrum in infrastructure, renewables, across all the subsectors that were talked about in the previous presentation, so battery storage, solar, and some of the newer technologies such as geothermal. And we've also had the opportunity to work with a number of different type of sponsors, so IPPs, utilities, and also financial sponsors. So from that vantage point, we've been able to have a seat at the table and look at the most recent types of financings, the financial innovation that's taken place all the way back from the IRA through to the Big Beautiful Bill. And what I can say, having observed that in the last few years, is that, and right now, is that the market remains very strong. I will echo what has been said just now by the gentleman from Energy, that it's extremely strong. Banks are ready to provide debt capital, at least for now. Some of the bottlenecks around maybe availability of personnel, both from our client side, but also from banks. I think most clients know that if you hit the banks right now with too many projects at the same time, you may run into issues in terms of closing timetables. So that's one of the bottlenecks. The others, which have been kind of mentioned today, is kind of working around the new reality after the Big Beautiful Bill. So FIOC issues, how are we dealing with those? How are we dealing with some of the tariff issues that have arisen? Again, they've presented some challenges in terms of making sure that they're wired into financing documentation, for example. But in the main, they've been resolved, and transactions are still getting done.
Matthew, I want to bring you into the conversation as well to talk a little bit about the role that insurance can play. And maybe tell us a little bit about the types of projects you've been involved in so far, and then maybe other potential future opportunities that you might see.
Yeah, sure. So I set this against the background that if we think about conventional infrastructure projects, then for a very, very rough sort of frame of reference, we think about 50% of the economic risks associated with those projects can find their way to the insurance market. And that makes a lot of sense. Insurance, including Liberty Mutual, has never been so well capitalized and looking to provide tools for leverage. But in the sustainable and clean energy environment, that's only about 30% of those risks have found a home into the insurance market. And many of you in the room will have had some exposure to tax credit insurance or all of the first-party construction, builder's risk, cyber, et cetera, that we're talking about. So that gap between clean energy, sustainable markets and the conventional infrastructure markets is both an opportunity for the insurance market, but also it's an opportunity for our customers to get kind of greater leverage in terms of finding cheaper finance, finding high quality finance, getting projects completed with greater certainty, and often then filling the gap of government intervention, which is now pulling away. So there's a framework there for us, not just in the United States, but across the world, having a more sort of intentional role in that project finance sort of value and the stack that goes with it. Now, Liberty Mutual, we have the biggest surety business both in the United States and around the world. So we get involved in at least half of the major infrastructure lead contractor projects that go on in the United States. So that means that we get an early look in the project prospect pipeline for us to be able to see that. So more and more we're organizing ourselves around getting on the front foot, identifying where through either the siting of projects exposed to natural catastrophes or getting our risk engineers involved earlier in the process, that we can make some positive interventions. So when that's brought into the capital stack, that can be more efficient, more quick, and more cheaply accessed.
So the title of this panel is a post-tax credit era, but I am struck that we are not in a post-tax credit era yet by any means. And in fact, we're very much in the middle of sort of sorting out tax credits post One Big Beautiful Bill. Eventually, we'll get post-tax credits, potentially. But it seems like the market, there's really kind of two segments of the market. There's the sort of legacy projects that got under construction and are not subject to some of the new provisions of the One Big Beautiful Bill. And then there's a whole slew of additional projects that are, looking to get built. So maybe to come to you first, Matt, and you, Susan. I mean, what's the difference between the two, and what are you seeing in terms of capital availability and financing?
Yeah, so I mean, the primary difference between qualifying for the legacy credits versus the tech neutral credits is that to qualify for the legacy credits, you have to have started construction in 2024. And so a significant portion of our pipeline that we're working on right now, started construction in 2024, which means that those assets need to be placed in service, in 2028 or sooner in order to maintain that qualification. And I think that those tax credits are largely the tax credits that everyone is kind of, familiar with and used to prior to passage of One Big Beautiful Bill. For the tech neutral credits, which you qualify for if you start construction in 25 or first half of 26, there's new, FEOC related, requirements that you need to meet.
Those are foreign entity of concern.
Correct.
Rules for those
And
who
so
don't
for
speak
the
Washington.
For the projects that start construction in 25, these are largely ownership and effective control tests that you need to meet. And then if you start construction in 26, there's additional tests that you need to comply with, and that's material assistance with respect to primarily your supply chain and making sure that your supply chain is not benefiting certain bad actors that the federal government is focused on. So because these new rules are new, people are taking time to really get a strong and firm understanding of what it means for their business and their ability to continue to monetize and take advantage of tax credits. So for example, some of the largest historical tax equity investors have been still somewhat slow to figure out whether or not they're comfortable with these rules as written, or if they need additional guidance to be released by Treasury in order for them to feel comfortable making new commitments on these tech neutral credit deals. And I think right now, the reality is that it's kind of easy for them to just focus on the legacy tax credit deals because that pipeline of projects is still pretty large, and they can just kind of focus on those projects because they're easier. It's kind of natural to focus on the low-hanging fruit. And as a result, I think the tax equity liquidity available currently for tech neutral deals is probably smaller than what we hope it will become in the near future, either once the legacy credit pipeline dries up and investors are now having to focus on these newer projects, or if there's additional guidance that's released that addresses some of the concerns that some of the larger investors have raised with the current legislation.
Yeah, I'll just add on that. And the industry, including, I'm also saying, I'm on the board of the American Clean Power Association, along with Invenergy and the leaders in somewhat utility scale oriented. But the industry started preparing for this moment to be able to have tax credits, and also the supply chain, which you've all heard about for years, of dealing with the concerns before with forced labor, China issues. So I think the industry's been planning for years to be able to be compliant with this type of restriction that would come. And what we're talking about with the tech neutral tax credits too, having those be also for tax equity investors who are in compliance, that are not foreign entities of concern. So I think some of this is more mechanical, needs to be worked out. And Ethan, but in Treasury, it's tax guidance and rules take time, and the rules need to be worked through with the experts. But I think the confidence that the industry, when I say the industry too, tech neutral tax credits not only apply to wind, solar, storage, but also geothermal, nuclear. It's across all of the different industries which now have the expanded benefit of tax credits. So making sure that we get the tax credit market opened up to invest across all of that is, and the experts who know are certainly putting in the comments to Treasury to clarify what's needed to make sure this is all workable and hopefully in the next few months to come.
Yeah, I'll make one editorial comment, which is the fact, as you note, Susan, that those additional technologies are part of the list, I think is a good thing in terms of speeding the process. I think there's certainly,
Yes.
this administration wants to be very supportive, or has suggested that it wants to be very supportive for nuclear and geothermal.
Yep.
So those technologies stand to benefit. So hopefully that will put pedal to the metal in terms of getting the rules
The urgency.
completed. Matthew and Eugene, though, I mean, for you, are there projects that, I mean, in terms of where you fit in this process, is it just legacy projects essentially that you're looking at now, or has anything come kind of far enough through the pike, from the tech neutral perspective that you're looking at any projects that are financeable at this point?
I mean, in the main, it's we're dealing with legacy projects when it comes to financing, because we finance what's, what our clients bring to us, and right now it's really about those kind of legacy projects that are being financed. We do have a good sight of line into other, possibilities that are coming down the pipe. For example, we think that geothermal is going to be something that's going to provide financing opportunities in the near term to the medium term. I will make one comment in terms of uncertainty. I do agree that is, at least for lenders, that is one of our worst enemies. So the environment that we're in now may not be ideal, but it has a certain amount of certainty attached to it. If you look at what happened, the crossover between the IRA and the BBB, there was a period of uncertainty, and from the lending perspective, that created a little bit of inertia and a little bit of a slight slowdown in terms of people not quite knowing what was coming next. We now know what we're dealing with. We know that sometimes it can be tricky to solve some of the issues that are associated with the BBB, but it's a more certain environment. So as far as lenders are concerned, we have that runway that we can look at projects and finance them. And I'll make one other point in terms of outlook. At the end of the day, the energy demand is driven by electricity demand, is driven by the need for power, which then drives the need for infrastructure, which then drives the need for capital, and in our case, debt capital. To me, that's a very healthy pull versus push situation. So as long as that lasts, then financing environment should remain reasonably healthy, and capital will find its way to where it needs to be. And if we look at the comments about post tax credit environment, it's not with us yet, but when it does come, if the demand is still there, then I'm reasonably confident that capital will find its way to where it needs to be. So, for example, I know that private credit right now is going through a bit of a rough patch, but I can see them playing a role in the future when it comes to getting the right capital stack for projects.
Yes, I would say something very similar to Eugene, but in a less articulate way, because the interesting thing about insurance, of course, is that it does tend to fill the gap as a risk mitigant that historically gets filled by governments, in this case with tax credits. So whilst Liberty Mutual is a big insurer in the tax credit space, we are anticipating quite quickly a post-tax credit world where that risk mitigant goes away, and there has to be a lot more focus on whether that's data analytics, on really understanding the risk up front. And as you say, within that environment, capital is going to flow more freely, and then we've seen with insurance with insurance partnerships around the world, actually that filling the gap very quickly. And I think we've heard sort of today the level of confidence because of the kind of organic demand that's been growing to fill that space, that feels like that capital is going to be able to flow very quickly and fill that environment that was supported by tax credits.
Does that, but Matthew, given the uncertainty between the guidance we've received from Treasury so far and what we need, what we're hearing with Susan and I think Matt were saying, what the market feels like they need to see for certainty, that uncertainty, is that something you guys can insure against, or is that just too open-ended a risk for an insurance policy?
That's difficult to give a yes or no. I mean, so insurance is all about fortuity. So yes, as insurers, we'll look at the information that's provided, and if there are fortuitous events, things that happen that no one expects legitimately, then we're prepared to indemnify for that. I think the area which becomes difficult in terms of getting mutual comfort both sides, as well as just the fundamental environment, is just in and of by itself ambiguous, and in some regards kind of almost ambiguous by design, it sometimes feels.
Yeah.
So I think that we've reached very good certain outcomes with many customers in this space. I think the longer it goes on, our risk appetite may be a little bit more limited if the environment just can't be resolved.
Susan, our poll notwithstanding,
Yes.
a lot of capital is going to be required, and there have historically been sort of multiple efforts to try to expand the availability of tax equity capital. Historically, it's been a limited number of maybe a dozen to a dozen and a half financial institutions that have done these fairly complex transactions. Maybe talk a little bit about the transferability market, and I know some of the efforts that you've been making about trying to sort of provide some greater uniformity, let's just say, to these types of transactions.
We're super excited that in fact, in the Inflation Reduction Act, we got tax transferability to help us expand the tax market, make it simpler to bring in buyers, help evolve while you still have tax equity partnerships to bring the tax capacity that we're going to need for the supply and the build we're going to have. And as that market started to evolve, I think the stakeholders are saying, well, this is great, but it's still too complex and we're not really getting the uptake we want from corporate buyers. So we kicked off under American Clean Power again as a broad initiative to bring stakeholders in on a neutral basis with, let's see if we can create a standardized ITC, eventually PTC document to create a market. Obviously, this isn't the same as an interest rate swap, but that market became a lot more liquid, a lot deeper, and somewhat simpler. There's still obviously transaction nuances by having a standardized, it's called the ISDA document. So we pulled together a group a year ago and now have launched, and we can provide the website later, a standardized ITC transfer document. And Crux is one of our partners in this, and I know they just did their market report, which I think is super important, was their uptake. But last year there was $65 billion in tax equity investment overall, increasing 26% from 24. $42 billion of that was with tax transfers. And that was up 50% from $28 billion in 24. And 15% of Fortune 1000 companies across sectors were involved. So just to give a sense of the scale and the importance that this market is there, it's expanding, and we believe there'll be a big opportunity now with further documentation and broader market education to grow the market for what we'll need, not only for, we're still talking about wind and solar, even with the transition for 5 years, but clearly we've got storage, which will be attached to that or standalone, or some of the new technologies to come that we're going to need billions and billions of capital.
And just to be clear, this is essentially like a standardized contract between buyers and sellers, and that's the idea, is so that you can eliminate the amount of sort of basic legal time on both sides.
Legal, due diligence, also give confidence, and it's a documentation that's meant to be Invenergy, any company could work with a corporate and do a direct transfer with these documents. But the large banks that are involved as tax equity investors are doing a huge amount of syndication as well, given the size of the need. And also, we see projects that may need $1 billion of tax equity. So being able to syndicate and manage that kind of one project concentration with a broader group of investors is important and will be increasingly so.
Eugene, I think you guys do some brokering of tax credits as well?
We do, yes. We do have a service that kind of matches buyers with sellers, as well as obviously putting projects together that involve a large amount of tax credit transfer, et cetera. What I will say, and I'm glad to hear that we're having these refinements that are going to make the market even more sort of liquid if it can. But my view is that tax credit transfer has been a success so far in terms of what we've seen, in terms of giving sponsors the optionality whether to go down the the transfer route or whether to go down the traditional tax equity route. Deals get closed quicker, so the velocity of kind of deal closing has increased because of it. And so yes, I know there's some technologies that are as yet untested for the tax credit transfer market. Carbon capture comes to mind amongst others. But I'm still of the view that they will be banked and they'll be able to be transferred. In terms of some of the risks attached to, whether or not the tax credit may have some element of recapture, especially for the newer technologies, some of that will be shown in the price at which the tax credit is transferred, rather than inability to transfer it altogether.
Maybe bring it back to you, Matt, for a second, because the intention of the transferability effort was to ultimately reduce the cost of capital and make it easier for people like you to develop more projects. Has it achieved that goal, or have we just stood up a nice market where a lot of people are shuffling tax credits and maybe making a little money along the way trading them?
I think the benefit has really been to increase the amount of liquidity available in the market to facilitate new projects. But for sponsors like Invenergy, where we were getting traditional tax equity before transferability was a thing, we were getting pretty attractive pricing in terms, and now those traditional tax equity investors know that our alternative is transferability, which inherently has a discounted credit value in transferability. So they're able to kind of price in that transfer discount into their product offering now. So it has increased in the cost of capital, but overall it's improved overall market liquidity, and we're certainly seeing volume be an issue too. And so I think as an industry, it's probably a reasonable trade to make. Is there's more liquidity and availability, but it's going to come at a cost.
I'm going to leave a couple minutes for some questions from the audience, but given the title of the panel, I did have to come back and ask, and maybe I'll start with you, Eugene, which is, obviously BBVA, major multinational bank, financed many projects elsewhere. Is this the most absurdly complicated project finance market in the world, and will we be better off if we eventually stop trying to do tax equity?
There is a point of view that supports that that argument. I think when it was just pure tax equity before transferability, I think it seemed to be a little bit overcomplicated for what you were getting. I do think that now with transferability in the mix, it is still complicated, but the overall benefit, I think, is worth the push. It's true that in other markets this doesn't exist. Obviously in Europe things are done differently, and that's what I was pointing out earlier on when I said in the long run, when tax credits expire and you have to find new ways of financing it, other ways of putting deals together will come to the fore. So yes, there is complication, but it works for now. Europe also has its downsides. For example, in talking about new technologies, when you look at SAF, which is something, sustainable aviation fuels, which is something that some of us are looking at. Obviously, the US has gone down the incentive route, which I think works as well. Europe has gone more down towards the kind of penalization route if you don't hit certain targets, and that has its advantages and drawbacks. So yes, it's complicated, but I think it works for now, and I'm pretty happy with what we have.
Anybody else if you had a wish list, how would you like it to be improved? Susan, you obviously aren't a tax provider, but so as an equity provider, does this make your life more complicated?
I think we'll end up in a position that without tax equity, we'll be able to simplify. And since we're a cash equity investor across the capital stack, that more traditional capital will be able to fill the full capital stack with more debt, more structured cash equity or preferred equity and common equity. And again, the key, particularly in wind and solar, is driving down our cost of capital. Our resources free. Yeah. So it's great to see earlier today that the LCOE forecast of BNEF for wind and solar without tax credits is still the lowest cost. And then the next part of that is just continuing to bring the capital to bear that'll drive out friction, drive out extra due diligence, and make sure we have projects that perform as assumed.
And Matthew, I don't know if you want to come in. Does it do we make life more cookie cutter for you in terms of insurability of projects? If we moved away from this model?
It would do, although I don't know. This is a complex environment all around the world, as you were saying. So I'm loath to say that the grass is always greener. So okay. Let's maybe deal with the complications we've got in front of us now.
Very diplomatic of you. Matt, did you want to come in? Do you want to add one more thing?
The only thing I would add is this is not a new debate. this industry has been facing the expiration of tax credits, pretty consistently for, more than a decade.
Right.
And so this is not the first time this debate has been at the forefront. I think, while you're in it, you obviously see the clear benefits of tax equity, but then once it's no longer an option, people adapt and kind of get used to a post-tax credit world. And the fact that it keeps coming back is beneficial, but it also makes us more susceptible to disruption as, regulatory policy and federal government policy changes as it does.
Great.
I'm just going to add, we're in a totally different environment than we have for the last 20, 30 years, as we know, with the demand for power prices increasing, and even I think we follow our developer partners, but as they're trying to look at what projects to develop, I think first, what are priorities? Where do you get the highest price for power? It's around where the loads are, whether it's data centers or industrial. So I think projects have healthier cash flows, healthier contracts, because they're actually being built where they're most valued versus just being, if you build it, they might come and tax credit subsidized. So it's a healthy outcome potential.
Dana, over to you for any questions from the audience.
Sure. So the first one gets to the heart of the bring your own power movement is how they refer to it as. So for any of the panelists, what is the appetite for investing in debt versus equity in clean energy projects that are co-located with and serving data centers? So this is both in front of the meter and behind the meter. What are you seeing? What is the appetite?
I can start from a lender perspective. Those present an attractive proposition and a logical one. At the end of the day, as was mentioned before, a lot of the power demand is driven by data centers. So bringing it to the data center makes a lot of sense, especially if you're able to bypass some of the issues with grid connection and transmission, et cetera, which, as we all know, is a bit of a bottleneck in terms of developing and growing power. So putting power right next to the data center makes a lot of sense, inside or outside of the fence. The people that own those data centers tend to be of good credit quality, so having that as a counterparty also makes sense. So we think that's a
It makes sense.
proposition. Yes.
Great.
I think as a power project developer, grid connectivity is more attractive, unsurprisingly. I mean, power projects are 40-year plus assets, and if you're, being installed solely to serve a data center, I think there's long-term questions around what is the useful life of a data center and how much power will they consume long-term. But it seems like in this environment, there's potentially a way to, recover your investment plus your return in a shorter time frame if data centers are willing to pay for it and they have no other alternative. So it's really more of a, I would say, kind of highly project-dependent analysis that you have to evaluate.
Okay. I'll do this one as a show of hands with an agree or disagree. So they've said if tax equity phase out and important duties remain, ultimately power purchase agreements are going to need to increase by the tune of maybe 20%. In Europe, we don't have tax equity but have access to global supply. So do you think off-takers are willing to have a higher cost? If yes, hands up. If no, hands down. And if you need me to repeat it, then I'm happy to do that too.
I have a yes, but.
Are we raising our hand for yes or no?
Hands up for yes.
Yes.
Will off-takers be willing to take the higher cost?
If the load is telling them to do that.
Okay.
Depending on how high the cost of.
And depending on how high the cost is. Okay.
Yeah.
So, to the tune of 20%, they were very specific.
That sounds a bit high.
A bit high. Okay.
Sounds a bit high. Yes.
Okay. Sub 20% then. All right, given the size and cost of projects happening, can the panel comment on changing collateral and other requirements needed to support project financing? So changing collateral being one, and are there other requirements that are actively shifting right now?
So could you read in terms of what?
Yes, the size and cost of projects is changing. Can you comment on whether there are other requirements or changing collateral that is needed to support financing? Maybe I read it wrong.
Yeah, I mean, I honestly don't, I'm not sure that there's a huge shift in terms of change in collateral given this.
Okay.
I think the fundamentals should remain the same in terms of putting the project together. And collateral is obviously a big piece of that. So,
Okay, the rules are the same.
yeah, exactly.
Ethan, back to you.
Thank you. Well, listen, thank you very much, Dana, and thanks to the audience for some interesting and elaborate questions as well, which is good, which we did our best to answer. So please join me in thanking this excellent panel. I think we covered a lot of great ground, so much appreciated.